So for this particular session, we are going to discuss IFRS 6, which is entitled Exploration for and Evaluation of Mineral Resources. This is particularly talking about wasting assets or those that are involved in the mining activities or those activities of entities that involves the extraction of resources from certain asset types such as yung mga properties or example a mining facility. Okay, those that are operating a mining facility or those that are involved in the exploration of properties such as yung mga mountain properties, yung mga areas that are rich in natural resources. Okay? So for IFRS 6, Exploration for and Evaluation of Mineral Resources, we're going to be discussing subtopics such as objectives and scope. We'll also be discussing recognition of exploration assets as well as mineral resources. And also we're going to have the measurement of these particular assets. We will have the presentation, disclosures, and impairment of certain assets that are belonging to this particular category. So to start with, we will have first the objective and the scope. So the standard provides the objective of IFRS 6 as follows. So the objective of the IFRS is practically to help or assist entities in accounting for items that belong to exploration and evaluation assets and other mineral resources. So in particular, these are the IFRS requirements. So first is limited improvements to existing accounting practices for exploration and evaluation expenditures. We need to take note that mining activities and similar activities that has the same nature has actually been existing already. And actually, if you look into the history of this particular standard, there are actually old standards that have been superseded by this standard, and the policy has consistently been applied with only limited improvements because basically the older standards have already are basically comprehensive already and will only require minor changes. Letter B, entities that recognize exploration and evaluation assets to assess such assets for impairment in accordance with IFRS and measure any impairment in accordance with IAS 36. So, again, in the absence of any other basis for impairment, we always refer to IAS 36 as our standard for the impairment of assets. Letter C, the IFRS also requires disclosures that identify and explain the amounts in the entity's financial reports relating to the exploration and evaluation of mineral resources, and also to help users of those financial reports on the nature, extent, timing, amount, and any cash flows relating to the exploration and evaluation activities of the entity. So let's proceed with the scope. So, according to the standard, an entity shall apply IFRS 6 to exploration and evaluation expenditures that it incurs. The IFRS does not address other aspects of accounting by entities engaged in the exploration for and evaluation of mineral resources. This simply means that the standard is only focused on how you are going to recognize these wasting assets or these exploration and evaluation assets in your financial reports, particularly in your financial position and in your financial performance. Other activities that are not covered by this standard needs to be accounted for in accordance with specific standards, or if there are no specific standards, based on the judgment of the management in accordance with industry standards and other particular documents that can help them in account for them. An entity shall not apply the IFRS or IFRS 6 to expenditures incurred before the exploration for and evaluation of mineral resources, such as expenditures incurred before the entity has obtained the legal rights to explore a specific area. Letter B, after the technical feasibility and commercial viability of extracting a mineral resource are demonstrable. So, what does this mean? This simply means that if you are going to apply IFRS 6, we need to focus only on expenditures and costs that were incurred at the time we have already ascertained that we have the right to explore and evaluate the assets pertinent to your activities. Okay? So similar to intangible assets, after technical feasibility, those are no longer considered, or those are no longer accounted for as part of the cost of the wasting asset. Okay? But it will be accounted for under other standards such as inventory, such as property, plant, and equipment, and all other standards. And then, before, this is similar also to research and development. Okay, so that's why when we discuss intangible assets, similar to how we are going to account for wasting assets, before the establishment of the right over the exploration and evaluation assets, this cannot be capitalized. Okay, because we need to make sure that the costs to be capitalized are only those that are obtained at the time the legal right to explore the specific area was established. Okay? And we will also stop the capitalization after the technical feasibility has been established. Okay? So with that, let us proceed with the next concept, which is recognition of exploration and evaluation assets. So first, let us focus on the temporary exemption from IAS 8, paragraphs 11 and 12. So what does paragraph 11 and 12 state? Okay? So paragraph 11 and 12 of IAS 8, which is accounting policies, changes in accounting estimates and errors, states that sources of these it specifies the following, no? So let's just read through. Paragraph 11 and 12 of IAS 8 specify sources of authoritative requirements and guidance that management is required to consider in developing an accounting policy for an item if no IFRS applies specifically to that item. Okay? Subject to paragraphs 9 and 10 below, this IFRS exempts an entity from applying those paragraphs to its accounting policies for the recognition and measurement of exploration and evaluation assets. Now, let's analyze this concept. Why is it that there is a temporary exemption from the provisions of IAS 8? So basically, the concept is like this. Once we have established already that we have an exploration and evaluation asset, then we can account for it already using IFRS 6. But the question is, since we are talking about letter A here, those that were incurred in relation to assets or expenditures before obtaining legal rights to the wasting asset, how are you going to account for it? Okay? So according to IAS 8, you are supposed to create an accounting policy for those items that do not yet qualify under certain standards. But since those activities before the legal right was obtained over the exploration and evaluation assets, okay, were also incurred in relation to IFRS 6, instead of establishing a separate accounting policy for that, the standard already, or the IFRS Foundation or the International Accounting Standards Board has already provided a temporary exemption for them, because anyway, it's not going to be relevant afterwards. So, to make it simpler, okay, the entity is no longer required to make an accounting policy for letter A, okay, because at the end of the day, it's still going to result to IFRS 6 accounting. Okay, so meaning, without crafting any other accounting policies, they can simply recognize items under letter A as either normal assets or normal expenditures. So example, if there are assets that were generated or assets that were recognized in relation to activities in letter A, then they can simply be recognized as other assets. And then expenditures or revenues that may have been earned or incurred, if any, can simply be recognized as other income or other expenses in your statement of financial position without the necessity of providing an accounting policy. Because again, the logic is once letter A is done and you already have obtained legal rights, it will still be part of IFRS 6 accounting already. Okay, so that's basically the logic there. Okay. So now, let us proceed with the measurement of exploration and evaluation assets. Okay? So the item states in paragraph 8, exploration and evaluation assets shall be measured at cost. Okay, so that's very self-explanatory. So meaning, going back again to letter A and letter B, okay? So those that were incurred in between A and B, okay? In between A and B, so meaning after letter A but before letter B, then those are considered as costs relating to your exploration and evaluation assets, okay? And those costs will be the basis of the measurement or the initial measurement of the exploration and evaluation asset. So that we will not have a difficult time in determining the measurements or the items of costs for the purposes of measuring your exploration and evaluation assets, paragraph 9 has already established the elements. So the elements of cost of your evaluation or exploration and evaluation assets are as follows. Okay? So take note that the following are examples of expenditures that might be included, but the list is not exhaustive. Meaning, there can be other costs that you can incur in relation to the exploration and evaluation assets that can qualify for capitalization for as long as they were incurred after letter A but before letter B. Okay? So basically, these are the items. First is acquisition of rights to explore. Okay? So meaning you were given either by the government, you were given by the private entity, okay, or whoever initially has the right over that particular wasting asset, you were given the right, so you acquired the right. Okay, so how much did you incur, okay, in order to acquire the rights over that exploration asset? So that's going to be capitalized. Letter B, topographical, geographical, geochemical, and geophysical studies. Okay? What are these particular items? Letter B are basically incurred in order for us to attain technical feasibility over the wasting assets or over the exploration and evaluation assets. So meaning, these are the tests that will allow us to achieve letter B stated here. Okay, which is going to give us an idea of the technical feasibility and commercial viability of our wasting asset already. Okay, letter C, exploratory drilling. Take note that this is not yet the commercial drilling. This is only pertaining to exploratory drilling in order to get samples, okay, and determine where, in what area are they going to start drilling first, what portion of the wasting asset has a rich content of minerals that are needed, etc., etc. So letter D is trenching. Of course, we need to establish the logistical component or the logistical area or part of mining activity so that we know how to transport, where we are going to place the extracted mineral resources, the ores, etc. Okay? Sampling, because we need to test all the items that were, or all the samples that were taken from the exploratory drilling, and activities in relation to evaluating the technical feasibility and commercial viability of extracting a mineral resource. This is letter F will generally include the seeking of expert opinion from professionals who can estimate and determine the total amount of reserves or total amount of mineral resources that are extractable in that particular wasting asset. Okay, because that will determine the technical feasibility and commercial viability. So after letter A and letter F, most probably you're already done with determining whether you can proceed with your commercial drilling or commercial mining. So these are the items that will be capitalizable for the wasting asset alone. Okay? Any items that you're going to incur pertaining to drilling equipment, other property, plant, and equipment that will be installed in the mining facilities or in the mining area and all others will be accounted for under a separate standard, which is most probably going to be property, plant, and equipment. And then whatever you are going to extract, the ores and mineral resources that you're going to extract are going to be accounted for under PAS2, which is inventory of the mining activity. Okay? So expenditures related to the development of mineral resources shall not be recognized as exploration and evaluation assets. Okay? Development of mineral resources. Okay? This is not pertaining to the asset itself, but rather the extracted materials. So how are you going to account for them? It's going to be accounted for under IAS 38 Intangible Assets. Okay? Next, in accordance with IAS 37, which is provisions, contingent liabilities, and contingent assets, an entity recognizes any obligation for removal and restoration that are incurred during a particular period as a consequence of having undertaken the exploration for and evaluation of mineral resources. So meaning, the entity needs to recognize the provision or a provision for the possible restoration cost, okay, of the property. Okay? So the next thing there is, since we already know the items that are going to be recognized in relation to the initial amount or the initial cost of the exploration and evaluation asset, let us now proceed with the subsequent measurement. So the subsequent measurement or the measurement after initial recognition, it states here that the entity will apply either the cost model or the revaluation model in accordance with the provisions of IAS 16. So it says there, if the revaluation model is applied, either the model in IAS 16 or the model in IAS 38, because basically it's the same, it shall be consistent with the classification of the assets. Okay? So we'll proceed with paragraph 15 later on so that we can determine how to apply that. Okay? Now, how about the changes in accounting policies? Okay? An entity may change its accounting policies for exploration and evaluation expenditures if the change makes the financial statement more relevant to the economic decision-making needs of users and no less reliable. So this is a general provision. So meaning, an entity who chooses, in paragraph 12, who chooses either the cost model or revaluation model can actually employ a change in accounting policy if it's going to result in a more reliable and more relevant presentation. Okay? Now, it should be justified in accordance with the provisions of ISA. So now, let's proceed with the presentation. Okay? So how are we going to classify the exploration and evaluation assets? It says there, an entity shall classify exploration and evaluation assets as tangible or intangible according to the nature of the assets acquired and apply the classification consistency. So again, what does that mean? After we capitalize all of these items, okay? That's why the list is not exhaustive because we need to understand this. After capitalizing A to F, we need to decide now in accordance with paragraph 15 how are we going to account for the wasting assets. Okay? Are we going to account for it as a PPE, meaning we are going to follow IAS 16, or are we going to account for it under IAS 38? The decision guide is very simple. did you acquire the actual property or did you only acquire the right to explore the property? Okay? So in that case, this is how we explain it simply. If you acquire the entire property, meaning you own the property itself, okay, and you are mining your own property, then you should account for it as PPE. Therefore, if you're going to account for it as PPE, then you're going to add additional items that are capitalizable, such as your decommissioning costs or restoration costs. It can be capitalizable and subject to depreciation later on, regardless of whether you are using the cost model or the revaluation model. Now, if you do not own the property, what you simply have is the right to mine on that property, then you do not actually have a tangible asset. What you only have is an intangible right to mine or to explore the asset. Therefore, you should account for it as an intangible asset and account for your wasting asset as an asset under IAS 38. So that's basically the decision guide. Now, since you already know the classification, then you are also going to refer to the specific standard to determine whether you are going to have additional capitalizable cost or no more. Okay? So, to sum it up, is basically like this. We go back again to paragraph 9. You get all of this, and then after getting all of these items, you are now going to determine if you will use IAS 16 or IAS 38, whichever is applicable to your situation or to the situation of the company. In that case, whether the entity must use IAS 16 or IAS 38, okay, you need now to determine what are the additional costs that can be capitalizable to your wasting asset as provided by the subsequent standard that you are using, which is either IAS 16 or IAS 38. Okay? Because this is very important, because whatever is capitalized will be the subject of your depletion, also known as depreciation or amortization, okay, depending on the type of asset we're talking about. Okay? So some exploration and evaluation assets are treated as intangible, meaning, for example, will be drilling rights, whereas others are tangible, okay, meaning vehicles and drilling rigs, okay. To the extent that a tangible asset is consumed in developing an intangible asset, the amount reflecting that consumption is part of the cost of the intangible asset. However, using a tangible asset to develop an intangible asset does not change a tangible asset into an intangible asset. Okay? So basically, what we're trying to say here is that after the initial determination of the cost of the wasting asset, you need to consider whether there will be added costs or no more. And if there are added costs, how are you going to account for it? Is it going to be recognized as a separate asset or is it going to be recognized as a capitalizable amount on the point of view of the original exploration and evaluation asset? Okay? Next, we go to the classification. Okay? An exploration and evaluation asset shall no longer be classified as such when the technical feasibility and commercial viability of extracting a mineral resource are demonstrable. Okay? Exploration and evaluation assets shall be assessed for impairment and any impairment loss recognized before reclassification. Okay, let us try to understand the first paragraph or the first statement. An exploration and evaluation asset shall no longer be classified as such when the technical feasibility and commercial viability of extracting a mineral resource are demonstrable. Which simply means, again, similar to what we said in paragraph 15, that you need to classify the exploration and evaluation asset as either a PPE or intangible asset. Okay? So that's basically what it means there. Okay? And then, since it is already considered as either a PPE or an intangible asset, then the exploration and evaluation asset will be subject to impairment in accordance with IAS 36. Okay? And since we're talking about impairment, the recognition and measurement is simply the same as what the standard IAS 36 states. Okay? So the impairment will be based on the evaluation of the carrying amount of the asset, of the wasting asset, and its recoverable amount. So based on the analysis provided and the discussions provided in IAS 36, you simply follow the same practice and the same rule. Okay? That's basically what it means. Okay? And of course, for the purpose of a cash generating unit, if the wasting asset belongs to a CGU, then you're going to allocate also the impairment based on the assessment of whether it is going to, or there's going to be an allocation of impairment, or there will be no impairment at all based on what we discussed in IAS 36. Okay? So what are, because when we discuss the other assets, okay, there are actually indicators of impairment. Okay, now for purposes of wasting assets, the standard also gave us examples of determinants or indicators that our wasting assets are actually impaired. So the first is um, the period for which the entity has the right to explore in the specific area has expired during the period or will expire in the near future and is not expected to be renewed. So meaning, the entity will have a shorter period of benefit on that particular wasting asset. Okay? Letter B, substantive expenditure on further exploration for and evaluation of mineral resources in the specific area is neither budgeted nor planned. So of course, if there will be greater expenditures, then the net cash flow will generally be lower. If the net cash flow will be lower, if you determine the value in use, then the value in use will also become lower, thus resulting to a lower recoverable amount after comparing it to fair value less cost to sell, whichever is applicable. Okay, then that's actually going to be a situation resulting to a possible impairment. Letter C, exploration for and evaluation of mineral resources in the specific area have not led to the discovery of commercially viable quantities of mineral resources, and the entity has decided to discontinue such activities in the specific area. So meaning, it is possible that initially there are mineral resources, but then as you continue to explore the area, you can no longer extract what you expected to extract from the particular area. So therefore, it's actually going to result in a lower recoverable amount because basically the value of the wasting asset will become lower. Okay? Letter D, sufficient data exists to indicate that although a development in the specific area is likely to proceed, the carrying amount of the exploration and evaluation asset is unlikely to be recovered in full from successful development or by sale. So meaning, at the end of the day, after you consider all the future activities and everything that you have done, okay, everything that you have invested in that particular wasting asset, you cannot actually recuperate the cost. Therefore, it's better for you to compute for the recoverable amount and determine whether there is going to be an impairment loss resulting to what happened in letter D. Okay? In any such case or similar case, the entity shall perform an impairment test in accordance with IAS 36, of course, which is the general standard applicable for all assets that are subject to impairment. Okay? Specifying the level at which exploration and evaluation assets are assessed for impairment. Okay? An entity shall determine an accounting policy for allocating exploration and evaluation assets to cash-generating units or group of cash-generating units for the purpose of assessing such assets for impairment. Each CGU or group of units to which an exploration and evaluation asset is allocated shall not be larger than an operating segment determined in accordance with IFRS 8. Okay, so of course, at a minimum, we need to determine also the reportable segment so that we can determine also how to allocate it or how to allocate the wasting asset to the specific segments or the specific operations that are benefiting from it. Because if they are benefiting from it, then they should also bear the loss relating to the impairment of the asset. So of course, we need to allocate that in accordance with the grouping that is determined in IFRS. Okay? So before we proceed with the disclosure, there are certain questions that we need to answer first when it comes to the when it comes to the measurement after recognition. Because we need to understand how we are going to account for other items that is going to be installed or that's going to be used in relation to the wasting asset. Okay? So let's have a discussion first. So first item, after we have already established the technical feasibility of the technical feasibility of the wasting asset, of course there will be additional PPE that will be installed there. Okay? So if the additional PPE are actually going to be permanently installed in the wasting asset, then they are going to be recognized as separate assets, but it will be depreciated in accordance with the life also of the wasting asset. Okay? So again, because we have let's reiterate, because after we capitalize all the items that are stated here, we already capitalized that. We already know the cost of the wasting asset. What are we going to do with the additional costs? Okay? So the additional costs, after we have already known or after we have already capitalized everything to the wasting asset, will be recognized now as a separate asset. So meaning they will be recognized as separate property, plant, and equipment. Now, the additional property, plant, and equipment that will be used to operate our exploration activities will be treated as separate PPE. Okay? The separate PPE or property, plant, and equipment will be accounted for and depreciated depending on whether they are permanently attached to the wasting asset or they can be used or removed, okay, and be used in other activities. So, what do we mean? So, if the additional property, plant, and equipment are permanently installed in the wasting asset and we cannot ordinarily remove that, then it will be depreciated based on the depletion rate of the wasting asset. Okay, so meaning the depreciation will be on the same percentage or on the same rate as how we deplete the wasting asset. Okay? And then for the property, plant, and equipment that are used but can be removed or can be transferred out of the mining facility or out of the wasting asset, they are going to be independently depreciated based on their independent useful life. So their depreciation will be independent from the depletion rate of the wasting asset. So that's basically what we're trying to say there. Right? Now, let's proceed with the disclosures. So the disclosures are very simple. So an entity shall disclose the information that identifies and explains the amount recognized in its financial statements arising from the exploration and evaluation of mineral resources. So, to comply with paragraph 23, these are the disclosure requirements. First, accounting policy for the exploration and evaluation assets. So this is where you are going to provide the accounting policy of whether you are using the accounting policy stated in IAS 16 or IAS 38. Letter B, the amounts of assets, liabilities, income and expense, and operating and investing cash flows arising from the exploration for and evaluation of mineral resources. So this is going to be disclosed in relation to the items or amounts presented in the statement of cash flows. Next, I think this is a separate requirement. Okay, so actually these are the only two items. An entity shall treat exploration and evaluation asset as a separate class of asset and make the disclosures required by either IAS 16 or IAS 38 consistent with how the assets are classified. Okay? So meaning, it's going to be like this. If let's say, for example, you are mining in a piece of land, you are not supposed to classify this exploration and evaluation asset as part of land. Rather, they are going to be classified as a separate class of PPE and call it as wasting asset or whatever account title you're going to use. But what is clear here is that they are not supposed to be grouped together with other classes of assets, even though they are similar in um, nature, okay, or similar in structure, okay. So that's basically how you do it, okay. And of course, if you are not supposed to, if that's going to be, if the wasting asset is a mineral right or is an extraction right, it is going to be grouped as a separate class of intangible asset in the case of IS 38 if you classify it as such. Okay? So again, just like what I said, the standard is already very old. Actually, it has been in existence since 2006 and there have been very minimal adjustments, okay, and very minimal modifications as provided in the paragraph in 26A, such as amendments to reference in the concept of the framework, because when the framework was adopted or when the framework was changed in 2018, particularly the paragraph 10 provision, then the standard will also be affected. But that's actually very minimal. There are no accounting, or there will be no significant accounting impact of paragraph 10. Okay, if you want, you can actually check this one and you can see that there is no direct impact. Okay, and then what else? All other provisions, particularly IAS 8, IFRS 6, basically. So everything is intact. Anyway, whatever we discussed here is actually already updated. We do not need to discuss the transitional provisions because basically from January 20, 2006, this has already been in existence, so no need for transitional provisions. This is only needed if you have been engaged in mining activities prior to 2006 and you are using a different accounting standard. Okay? So there are certain definitions here. They are not added to the standard or to the main text of the standard, but rather they are part of the appendices. So we have exploration and evaluation assets, okay, which are assets in accordance with the entity's accounting policy. Okay, so it depends. But again, we already stated that exploration and evaluation assets will be treated either as PPE or intangible asset. Exploration and evaluation expenditures, these are whatever you incur before the technical feasibility and commercial viability of extracting, okay? But after acquiring the right to explore the asset, okay? So meaning, when we were discussing a letter A and letter B in the earlier part of this text, it simply pertains to all the costs in between A and B. Okay, we have exploration for and evaluation of mineral resources. So basically, this is the search for mineral resources, including oil, minerals, natural gas, and other types of resources after, after the entity has obtained legal rights, but before, okay, the determination of the technical feasibility. Okay? So meaning, we know when to start the capitalization and we know also when to stop the capitalization. Okay? So I think those are the only items. Appendix B are simply the amendments relating to the IFRS. But these have no direct impact to our discussion. Okay? So these are the remaining items. No other provisions. So these are just the formalities, those who signed and those that are involved in the preparation of the standard. Okay, so with that, that's actually the end of the discussion for IFRS 6, Exploration for and Evaluation of Mineral Resources.